Give us your own sense, first and foremost, on this issue, on how the e-commerce players have been hit hard, and particularly PDD, the problem here, because from what I remember, just 6 months ago, or maybe that was a couple of quarters ago, Pinduoduo was seen as a shining star of the e-commerce play because they were expanding so rapidly overseas.
Yeah, that's a great question, Tanvira, but I think a 30% drop is too large of a correction. I actually think Pinduoduo is a good buy at 30% down because it's still growing well. It failed to hit expectations of analysts, but you're still growing 20, 30%. You're still getting billions of dollars of revenue. And I think that the Chinese consumer is still trading down. The economy has really hit a wall in the last 6 to 8 weeks. Chinese consumers are scared. They're still going to be trading down, buying more on brands like Pinduoduo. And actually, I think Costco and Sam's Club from Walmart are doing very well because the name of the game for right now, for the rest of the year, Tanvir, is value for the Chinese consumer. Now, you brought up a great point. I just got back to China after traveling around the United States and the UK to meet with hedge funds. I met with about 80 of them. Almost every single one of them said, what do you think about Pinduoduo? We think that the valuation is too high, but we're investing in it because everybody else is investing in it. They're also worried about allegations of fraud. They're worried about the regulatory issues. So they were in it because they didn't want to miss the ride up. I think last night, a lot of the guys sold because they don't want to be on the ride down. But I think this gives a good opportunity for funds to come in. It's not going to grow 30%, and reach the numbers it had anytime soon. But I think that the fear and the panic was overblown last night. I think this is a good time to buy in.
Okay, interesting. Let's just understand Pinduoduo's model and what can help it stay afloat or rebound from here, Shaun, because it's primarily predicated on group buying at affordable prices. Now, at some point in time, that would hit the bottom line because how much can they keep subsidizing prices for the customer at a time when you're talking about cash burn being a major concern, a major red flag for e-commerce players globally, not just in China. And so I want to understand how Pinduoduo can survive, how the economics can work for it to survive as it gains market share, both domestically as well as internationally.
That's a great question. So Pinduoduo got famous for its group buying and sort of essentially subsidizing the consumer spending because they were trying to get market share rather than profits. But in the last few months, they've rolled out more direct buy opportunities, kind of like a JD, kind of like an Alibaba. And that's also proven very popular with Chinese consumers. Even though actually the prices are not necessarily cheaper on Pinduoduo than Alibaba, it's got the mind share. Consumers, when they want something cheap, they go to PDD. But I think the real growth for Pinduoduo is going to come from Temu. You even see that Bangkok Post last week said that they're trying to create stronger ties with PDD's Tmall line because Thai consumers are buying so many products. Inflation is still a big problem around the world, which is why you see Americans, Europeans, Southeast Asians are buying on Temu. To me, the real growth opportunities is overseas. Now, that comes up to the regulatory issues. You see the EU, you see the United States are trying to close loopholes that allow Temu to bring in products basically tariff-free because they're sending in small bundles into Europe and the United States. That definitely is a risk, something consumers need to worry about, but I think that growth is going to continue because the consumers demand it. And I don't think competition like Amazon or Alibaba are going to be able to catch up with PD anytime soon.